in the next few minutes, I'll try to explain the factors which are affecting the Indian banking sector. So the first factor is asset quality. Of the total loans, only 2.36% of the loans are recorded as bad loans, and for the loans which are not being paid in a finite period of time, the banks have made provisions for these loans to be paid over a longer period of time, and these loans are classified as restructured loans. Both together, restructured loans as well as bad loans consist of 10.9% of the total loan book, and the value at risk for the Indian banks is 36.9% of the total assets. However, the bank's capacity to absorb the losses is only up to 7.9% of the total loans. So, in a case of severe credit default, the bank's situation will be exacerbated. The next factor is capital adequacy. RBI has mandated for all the banks to maintain a portion of the deposit to be kept for the provisions of the bad loans. When CR falls below a particular level, banks need to borrow the funds or use the depositors' money for lending operations, which makes the cost of capital higher for the banks as the depositors can withdraw money anytime they want. Another measure of CR is capital to risk asset ratio, which is falling steadily for the Indian banks, especially for the public sector banks. Further, the public sector banks are not able to raise the capital, and as a consequence, it may be possible that some of these banks are not able to maintain the CR as per RBI guidelines, which may in turn hold their operations. The next factor is deferment of the provisions. So, some of the banks prefer to defer the provisions in order to show good financial results. However, the impact of the same will be temporary and not tend to last in the longer term. So, in the longer term, the investors' confidence will come down anyhow. Further, the banks are vulnerable to the future economic shocks in case they are deferring the provisions, as at the time of economic shock, their profits will suffer. The next factor is governance issue. So, the first issue is agency problem, where the managers are not acting in the best interest of the shareholders, whether it be a case of Nirav Modi and Mehul Choksi or it be a case of Vijay Mallya. The offenders make use of loopholes in the banking system by collaborating with the official of the banking systems and hampers the confidence of general public in the banking systems. So, it includes giving loans to corporate borrowers whose credit rating does not make it worth to lend this corporate borrowers. Further, in some of the cases, some of the banks underreported the bad loans to hide the true representation of the balance sheet of the particular company in order to maintain the confidence of the shareholders in the company. The next factor is failure of NBFC. So, collapse of non-banking financial firms such as ILFS and DHFL led to liquidity crisis in the system and made it difficult to raise the funds from the capital markets as the investors' confidence in the capital markets is decreasing. And the reasons behind the collapse of ILFS was, so basically ILFS was funding its longer term assets with the shorter term funds, which is measured as asset liability mismatch. However, IL&FS find it difficult to raise the funds from the capital markets after rating agencies downgraded its commercial papers, which triggered liquidity crisis. And due to IL&FS liquidity crisis, the non-banking financial firms collapsed as they have majorly invested in the ILFS, and the economy took a hit.